There are a number of considerations that every entrepreneur must take into account before they start their business. Some of these issues are fundamental to getting started, and some are things that you should start to consider as you move down the entrepreneurial path. By the end of this unit, you will be able to understand the various dilemmas facing founders, as well as identify the various available funding sources and legalities of starting a new business. One of the challenging parts of starting a business is determining how much money you'll need to get started and where it will come from. We typically see a number of sources of startup funding. 1. Personal investment, often called owner's equity. 2. Banks, in the form of credit cards, line of credit, and loans. 3. Investor contributions, in the form of angel investment or venture capital invested in exchange for a percentage of ownership in the business. And 4. Bootstrapping, which is how we describe pulling it all together on your own. Let's take a quick look at each type. Please note that there is more information about each of these topics than we can cover in this unit. You'll want to dig deeper into other sources of information before making decisions related to your business. Owner's equity, the single biggest source of early-stage startup financing, comes from the entrepreneur, the founder, and co-founders putting their own money into the business. At least initially, it may be very hard for a startup to convince others to lend or invest in your business. So funding your startup comes down to how much confidence you have in the venture and your willingness to invest in your own personal money. Banks and equity investors will be very interested to see just how confident and committed you are in your business before they make their lending or investment decisions. Having your money in first goes a long way to demonstrate this commitment. Common sources of owner's equity include things like personal savings, cash from second mortgages, and personal credit cards and lines of credit. Banks. Banks are very important for startups and early-stage companies, but don't be fooled into thinking they will lend you money lightly. Their contribution to the finances of your business will often come in the form of owner-guaranteed credit cards and lines of credit. As the business gains traction, banks will become more comfortable lending larger sums in the way of loans and other financial products. Remember that banks have specific mandates, rules, and regulations as to how much risk they can take. It's best to engage your bank representative early in the process and keep them informed along the way. Equity investments. Equity investment refers to the money that is invested into your company for equity in a proportionate share of your company. The equity investment typically comes in the form of angel investment for earlier stage opportunities, or venture capital for larger and often later stage opportunities. The investment process is a study in and of itself, and you should learn more if you believe this is a viable option for you. For now, let's look at a few key concepts. 1. Angel investors, or angels, and venture capitalists, also known as VCs. Both groups invest money in the companies for a piece or part ownership stake in the company. If the company is successful, they own part of the company and therefore part of that success. But if the company doesn't do well or fails, they will have lost their money, so these are risky investments. To compensate for this risk, equity investors look for deals that can provide high returns. These are often very high growth potential businesses that can operate in big markets with some sort of competitive advantage, such as intellectual property. In both cases, these investors usually have specific preferences as to the industry and the stage of the idea or company they invest in. Angels and VCs differ in that angels are investing their own money, and VCs are investing from a pool of money that has been placed with them in order to invest in this high-risk, high-return asset class. Knowing what investors are looking for, the type of industry they invest in, and what stage of the business life cycle they invest in is critical information for startups who think this might be a viable option for them. 2. Valuation. Valuation is often a term you hear related to equity investment, including both angels and VCs. When an equity investor decides they would like to invest in a deal, there are a few numbers that they need to decide on. or negotiate by the entrepreneur and the investor. First, there needs to be agreement as to how much money is to be invested in the company and the timing of the money. Second, the two sides must agree on the value of the company prior to the investment. Once this is known, as well as how much is being invested, it's easy to calculate what percentage of the company the investor now holds as a result of their investment. For instance, if the two parties agree that the pre-money value of the company is $1 million and the investor is investing $500,000, then the total value of the firm immediately following the investment is $1.5 million, and the investor is responsible for $500,000, or 1/3 of the total value. They now own 33% of the company. The process is rarely easy, as the investor would like to see the pre-money value negotiated as low as possible, so they end up owning more, and the entrepreneur will push for a higher valuation, so they maintain more ownership. These details are outlined and agreed to by both parties in what is referred to as a term sheet. The situation also becomes complicated if and when another investment round is required and the ownership equation gets larger. Again, we'd encourage you to look further into equity investments if you believe this is an option for you. 3. Exit. For both angels and VCs, an exit is a desired outcome of an investment. An exit means that the investor is able to sell their stake in the company to someone for a larger amount than their original investment. That's why they invest, to make a return. An exit usually comes in one of two forms: the sale of the company to another, usually a larger business, or the company doing what is called an initial public offering on a stock exchange, like the Toronto Stock Exchange, opening the purchase of shares in the company to the general public, and allowing the equity owners to sell their shares on this market. A couple of key points to remember. First, if there is no possibility of a future exit, such as being able to grow big enough to do a public offering or being interesting enough to another company to be purchased, it will be hard to attract investment to begin with. In addition, founders and co-founders need to be aware and comfortable that one very frequent and popular exit option is the sale of the company to someone else. Of course, this means you no longer own the company you founded, and you need to be prepared for this if you go down this path. Bootstrapping. After equity investments, bootstrapping is our fourth source of funding. It's a term we often hear in relation to early-stage startups and refers to a means of financing a company through the creative acquisition and use of resources without raising cash from independent investors. As you will recall from the unit on financing, if you don't take equity investment from an angel or venture capitalist, you keep 100% ownership and control of the company. Likewise, if you don't have to borrow money, you'll be much more financially independent. There are a number of techniques we see in bootstrapping. They include, but aren't limited to, the following. 1. Generate revenue quickly. This may seem obvious. However, you'd be surprised by how many firms give up short-term revenue in order to make their product a little bit better, or pass up opportunities to generate revenue with related products or services while they build out their intended product. There are many examples of startups generating consulting revenue in a related or unrelated field in order to fund the development of their primary product. 2. Focus on your cash flow. Focusing your efforts on your cash and your cash flow estimates will help you make educated strategic decisions around the timing of cash expenditures and the amount of cash you burn through each month, often referred to as your burn rate. Look to purchase used equipment, shared supplies, equipment and space with other businesses, and look to eliminate any unnecessary costs where and whenever possible. 3. Suppliers. Suppliers are often a great source to tap when you're looking to stretch your startup dollars. Ask them for longer payment term and opportunities to buy now and pay later. You may also be able to barter your suppliers, meaning exchanging their goods and services for your goods and services, rather than cash. 4. Customers. In some instances, you can ask your customers to prepay or partner with you in the development of your product in return for them getting to influence the final product, provide customization, and be the first to use the product once it is finalized. 5. Programs. There are a number of government funding programs that help you to leverage the dollars you are spending. These may include wage subsidies and tax credits. For a complete and up-to-date listing of these sorts of applicable programs, consult your local Small Business Enterprise Centre and the Government of Canada's Canada Business Small Business Portal. 6. Your team. In many startup situations, you can and may have to ask your early team members to forego, reduce, or delay compensation, employ relatives and/or friends at below-market salaries, look for volunteers and co-op students, pay with stock or stock options, and ask the team to work from home. 7. You can help to bootstrap by using personal savings, credit cards, and personal loans, foregoing, reducing, or delaying your own compensation, sometimes called sweat equity, working from home, and even developing your product at night and weekends while working elsewhere. Bootstrapping isn't easy, but it is an essential part of most startups' early days. Don't think of it as being cheap. Rather, it's an attitude and a business lifestyle that has you focused on the relentless preservation of your startup's life's blood. That is, your cash. The last set of pre-launch considerations we will discuss are startup legal issues. There are 3 main issues in the legal realm. These are the business legal structure, employment, and intellectual property protection. The intellectual property issues will be discussed in detail in another module, so we will focus our attention on the business legal structure and employment. Many first-time entrepreneurs are overwhelmed by legal issues as they don't understand the legalities and don't have the money to hire a lawyer. So how do you go about legal protection? The answer is in the minimum viable legal protection. Start by educating yourself and use lawyers as needed. Many lawyers that work with startup have lots of available resources that can be downloaded for free. Moreover, many of them are ready to defer their fees until the startup is funded, provided that they believe in the startup's potential. So when do you go to a lawyer? The best time is after you have spoken to potential customers and validate that there is enough interest in your business idea. So it is essentially when you know that there is a high potential of success. Business legal structure. There are 2 primary types of legal structure for businesses, and you will need to choose one when starting a business. Your decision should be based on your own research into these legal structures and the benefits and pitfalls of each. In addition, the form of legal structure you choose should be based on your own personal situation and long-term goals. There is a lot of information available online related to business structures, and we'd encourage you to seek this information out as you research which is best for you. For now, know that the forms include sole proprietorship and corporation. A sole proprietorship is the easiest and most common form of business structure. Effectively, in a matter of minutes, you can register with the Province of Ontario online, be legitimized in the eyes of the government, and start selling. This form of business structure allows businesses to get up and running very quickly and is relatively inexpensive. As a sole proprietorship, you can operate under your exact legal name or choose a business name to operate under. In either case, you'll need to let the provincial government know during the registration process which you choose. You'll also need the registration form, also known as your master's business license, in order to open a business bank account so you can deposit checks. As a sole proprietorship, you and the business are one and the same in the eyes of the government and the Canadian Revenue Agency. You'll still be able to account for your business expenses as any other business, only you'll add this net income to your personal income tax at the end of the year, like you would if you were receiving a wage or salary from a job. Corporation. In doing an incorporation, you are setting up a separate legal entity in the eyes of the government and the Canada Revenue Agency. You'll be required to file income tax returns for the corporation in addition to your personal income tax returns. This separate legal entity is useful for a number of reasons, including being able to split up equity among co-founders and investors, providing some separation between you and the company, providing for limited liability in the event of legal action against the company, and possibly providing some financial benefit depending on your personal financial situation and how and when you choose to draw money out of the corporation. You should look closely at the pros and cons of each structure before you choose, as well as consider your personal financial situation in making the decision. In addition to the information available online, you may also want to seek out legal and accounting advice in your decision-making process. Employment law. Employment law applies to all companies, even if it's just a startup. There are different standards for different jurisdictions, so make sure you know what the employment law is for your province. You should remember that different people have different expectations and that circumstances change. Thus, it is important to have employment agreements in place early on so unmet expectations don't turn into nightmares. An employment agreement should include the job title and description, pay, equity, etc. Moreover, it should discuss the divorce terms, basically what the terms would be between the employee and the company if things didn't work out. You should consider issues such as what happens to the shares and how much notice is needed for resignation. Employment agreements should also spell out post-divorce restrictions, which include confidentiality, non-competition, and non-solicitation agreements, to name a few.